I am Anil Kothari from the research team at MFA, and you're watching the story of our markets. Let's begin with the global picture. April turned out to be one of those months where markets were constantly shifting between relief and fresh uncertainty, almost like watching headlines move prices in real time. The global macro environment remained surprisingly resilient even as geopolitical tensions between the US and Iran dominated the narrative throughout the month. The month began on a positive note after Iran's foreign minister announced that a ceasefire proposal has been accepted. Markets immediately reacted with relief, and oil prices cooled sharply from nearly USD 110 all the way down to the USD 86 mark. For a brief moment, it felt like global markets could finally take a breather from the uncertainty around the conflict. But that calm didn't last very long. Within 24 hours, Iran announced restrictions on vessel movement throughout the Strait of Hormuz after the first round of negotiations failed. The sticking point remained Iran's refusal to completely halt its nuclear activities. In response, the US president announced restrictions aimed at limiting Iran's oil exports through the strait. That announcement once again pushed oil prices sharply higher, with crude now trading back above the USD 110 mark. And this is when things become more complicated for global markets. Higher oil prices are not just about energy. They feed directly into inflation expectations. As a result, central banks across the world chose to hold interest rates steady, while also sounding more cautious about inflation risks going forward. Adding another twist to the energy story, the UAE officially exited OPEC during the month. Since the UAE has been one of the larger oil suppliers globally, this move weakened OPEC's overall grip on supply management. Markets are now trying to assess whether this could keep oil prices elevated for longer than expected. Meanwhile, gold, which had rallied sharply earlier, entered a corrective phase and slipped below the USD 4,600 mark. On the diplomatic side, Iran also appeared to be exploring alternative mediators beyond Pakistan, with fresh discussions involving Russia and Oman, both of whom had earlier played key roles in negotiations. Despite all this geopolitical noise, US markets remained surprisingly resilient, supported largely by better than expected Q1 earnings. In fact, that has become an interesting theme over the past few months. Markets appear to be reacting less emotionally to geopolitical headlines and focusing more on earnings and liquidity conditions. Looking at the broader global picture, major central banks including the US Fed, ECB and Bank of Japan chose to keep interest rates unchanged while maintaining a cautious stance on inflation and growth. Back home in India, the domestic data remained fairly stable. Now, GST collections and PMI data continued to reflect healthy economic activity and improving business momentum, even as industrial growth softened slightly and inflation edged higher. On the flows front, FIIs remained heavy sellers in April, pulling out over 70,000 crore, while DIIs continued to provide support with purchase of over 51,000 crore. This tug of war between foreign and domestic flows continue to define the market structure for now. Going ahead, the biggest risk remains any further escalation in geopolitical tensions, especially if oil prices continue to remain elevated. Now, higher crude prices for a prolonged period could impact global growth expectations and create volatility across emerging markets. Stronger than expected US data could also delay rate cut expectations and strengthen the dollar further. That said, markets have shown impressive resilience over the last few weeks. Since the ceasefire announcement, markets have managed to recover almost the entire decline seen during March and early April. The focus now appears to be shifting back towards earnings rather than reacting sharply to every geopolitical update. We believe markets may consolidate for a while from here, looking for fresh cues from Q1 earnings and developments around the ceasefire negotiations. Valuations have become more reasonable after the recent correction and are not looking stretched at the moment. So the broader message remains unchanged. Despite the volatility and headlines, investors should continue focusing on the long term and use phases of uncertainty with discipline rather than emotion. That's it for this edition of the Story of Our Markets. Thanks for watching, and as always, stay invested, stay informed.